on the Chinese stock market and its recent losses. We're joined by Dan McClory. He's a managing director at Burnham Securities. Dan, heard one analyst say today market sell-offs always end, and of course that's true, but that doesn't provide much comfort for these jittery investors. What's driving this, and what do you expect to see when the market opens today?
Well, thanks for having me on the show, Mike. I appreciate it. I think we're going to see further drops. I think there's still a major correction underway in the Chinese equity markets. They've been overpriced for some time. We've known that they're extremely volatile, but I would expect to see further drops on the Friday of trading in China.
Manufacturing, an economy in transition. We're also talking about the currency. What do you think's the drivers, or all of them drivers?
Well, they're all drivers, but let me go on record as saying I think there's been a global overreaction to the correction in the Chinese stock market by other major stock exchanges. And what I mean by that is I think we have a systemic problem with the circuit breaker first and foremost, where if you compare it to the U.S., it takes a 7% drop to halt trading in the U.S. for 15 minutes, a 13% drop to halt it for another 15, and if it goes down 20%, the S&P that is, then trading is halted for the day. And by the way, that has never happened. Trading has not been halted for the day because of a drop like that. I think the trading bands, Mike, with the circuit breaker in China are way too narrow. I think they need to be widened to take into consideration the volatility of that market. And there are many corrections coming. There are a lot of overpriced equities in China.
So if you were there and advising them about the circuit breaker, because as you mentioned, the U.S. has one as well, it's meant to put the brakes on things, to cool things off. It seems to have the reverse effect. What would you advise them to do?
I think suspending or dismantling the circuit breaker for now is a good idea. I think a market trend has to play out with Chinese equities. I think what we're seeing is the largest investor education program probably in the history of the world, where investors are learning that things that go up also come down, and that the government's role is not necessarily to make sure that you never lose money. Volatility comes with the markets. And I think there are some other inherent factors in the Chinese equity market that make it difficult for it to function in a truly open market fashion. I'll mention a couple to you. Number one, there's very limited availability of futures trading. As you know, in other global markets, traders can hedge positions and effectively insure or lock their downside as well as locking into an upside. It's extremely difficult to enter into futures contracts in China. Also, because of the settlement system in China, it's very hard to buy and sell the same security in the same day. You're effectively trapped in a security until the next day, which then leads to, again, more of a sense of panic and I must get out. So I think these are all some systemic factors that China will absolutely address. I think they should be addressed very quickly.
Let me get back to one of the things you brought up, which was the reaction or overreaction. Talk to me about the interconnectedness of these markets. I'm hearing a lot of people say China sneezes, the rest of the world gets a cold. We are seeing these markets tumbling. I was reading Australia's shares lost about $33 billion in value. Undoubtedly, they're watching what's going to happen in China today as well, very closely. Can you talk to us about the interconnectedness and, as you said, perhaps this overreaction?
I firmly believe it's an overreaction. I don't believe that what happens in the Chinese stock market should affect what happens, for example, in New York or NASDAQ running down directly. I think some of the other factors you mentioned at the beginning of the show, Mike, such as a rebalancing of the economy, such as decelerating GDP growth, such as the yuan kind of finding its place and a little bit of turbulence back and forth there. I think all of those are factors that contribute to a global lessening of confidence in China, or China being the consumer of last resort, which of course it no longer is. And those would all be causal factors for there to be a correction. But the absolute connection between the Shanghai or the Shenzhen indices falling and that spreading like the wave across Europe and all the way over into North America, those should be uncorrelated in my opinion.
It's pretty early in the year. I mean, we're just into just a few days. Is there light at the end of the tunnel? I mean, when should we stop panicking?
Well, again, I think the market, just when, we've talked to your colleagues this past summer, the last week in August was particularly brutal. I think there are further corrections. I think more of a market economy outlook has to settle in. And I believe that the CSRC, which is the securities regulator, and the People's Bank of China, I believe they both understand this. And I believe they have ideas and policies that can help enact this. But I think when it ends up at the state council level, then you have other sets of eyes and ears that are really giving guidance and direction here that perhaps aren't as market savvy as those practitioners at CSRC and the People's Bank of China. So I think listening a little bit more to those who are closer to the market within China would result in some solutions being arrived at.
Dan McClory joining us from California. Thanks so much.